You're listening to What's Up Digital Lending, the podcast that explores the exciting world of digital lending. We make a deep dive into the most important issues and talk to the leading minds of the ecosystem.
Welcome everyone, this is episode number 11 of What's Up Digital Lending. Today we are finally starting the second season. Wow! We took a bit of a break because we wanted to sort ourselves and decide on the topics for the next 10 episodes. I think we now have a great program for the next few months. Don't forget, if you have any ideas about what we should talk about here, just get in touch. Apart from planning, there was also a lot going on in our association. In April, a super exciting conference took place in Frankfurt, which we organized together with Finfellas from Riga and Latvia and the international law firm Linklaters. Under the eponymous title What's Up Digital Lending, we brought together just over 100 institutional investors, fintech lenders and service providers from 16 countries. It really was a lot of fun and great success. You can find the link to a short 1.5-minute clip in the show notes below. Check it out. Next year, the event will take place for the third time on May 21st, 2025. So, make a note of it already today. To give everyone who was unable to attend this year a taste of the event, we are publishing panel number 2 as a podcast today. It's the fabulous investor panel with Daniel Dobrev, Director Speciality of Finance at Fortress Investment Group, Conor, Sheehy, Head of Warehousing, East Middle East Asia at HSBC Innovation Banking, Michael Stott, Managing Director at Waterfall Asset Management, René, Trautner, Director at Deutsche Bank, and finally Sebastian Walf, Managing Director and Head of Asset-Backed Securities, East Middle East Asia at Citi. As you can see, it was really top class. The moderator was the amazing Jördis Heckt-Harbeck, Counsel at Linklaters. The title of the panel was The Battle of the Asset Classes, Digital Lending, Returns and Risks in Volatile Times. Before you start listening, please note, the content of this podcast is expressly not to be considered investment advice, but is intended solely for your information. And now, let's fire it up, folks.
Let's start with panel number 2. So now we are giving a voice to the investors, and with investors I mean institutional investors. And we have a number of institutional investors with us today. Maybe because I've been talking quite a while already today, so I'm Jördis Heckt-Harbeck. I'm a lawyer here at Linklaters, focusing on all sorts of asset-based finance. So this is more or less my home turf as it is for the panelists. So may I ask all of you to introduce yourselves, maybe starting with you, Daniel.
Absolutely. Is this working? Yeah, it is. Hi, Daniel Dobrev. I'm a director at Fortress in the Speciality Finance team. I'm based in London. If you don't know Fortress, it's a global diversified investment manager. Started as a private equity house back in the late 90s in the US. Focus lately has been mostly on alternative credit. And in terms of the specialty finance team, which I'm part of, we have 2 main investment mandates, investment strategies, call it whatever. One is litigation finance, quite niche and I would say quite irrelevant for this panel. But what's more relevant is the other one, which is our lender finance business, where we effectively provide asset-backed financing solutions to digital lenders through senior stretch, mezzanine facilities, forward flows. We can buy portfolios of assets as well. So yeah, this is it in a nutshell.
Hi, everyone. Hello, everyone. Nice to meet you all. So my name is Conor Sheehy. I head up warehouse finance business at HSBC Innovation Banking, formerly known as SVB. So SVB and HSBC Innovation Banking's mission is to support the innovation economy. As part of that, we provide asset-backed financing to innovative digital balance sheet lenders operating in consumer, commercial, real estate markets across EMEA. We tend to target credit enhancement comparable with investment grade rated ABS, but typically command a higher spread for the bespoke nature of the structuring of the warehouse, the esoteric nature of the asset class, and or the lack of performance track record of the underlying assets. I guess on that point, the margin on our transactions tends to range anywhere between 300 and 800 basis points over the relevant benchmark, and we tend to have a minimum entry point of 20 to 40 million US or euros, and hopefully then grow over time. The business was set up 3.5 years ago. We are just shy of $500 million of aggregate commitments. It's probably worth noting that I've come from London as well, similar to Daniel. The team is based out of London, but over 2/3 of our portfolio today is financing loan originators that are incorporated outside of the UK. What else? I think that's pretty much it. Maybe just a comment on our footprint in the German market. So. HSBC Innovation Banking no longer has a physical presence in Germany, so we tend to rely on reverse solicitation today. We work with a range of German businesses which may be known to some of the audience today, so that would be the likes of Aux Money, Modify, Get Moss, Recap. They're all of our public German deals. So even across the range of those names, you get a sense for the diversification of assets that we're currently funding, such as consumer loan, trade finance receivables, corporate charge cards, and cash flows derived from B2B SaaS contracts. So yeah, that's me. Thank you, and I'm happy to be here.
Hello. My name is René Trautner. I'm with Deutsche Bank. I'm actually based just around the corner here in Frankfurt, where we have a small local ABS and asset finance team, thanks to Brexit. I guess, as you would imagine, from a large investment bank, we offer a pretty wide range of investments that we do, from classic senior warehouse financing to also stretch seniors. We sometimes underwrite and organize mass for clients. We also do forward flow or portfolio, active in portfolio sales. And I think the investment size, just to perspective, I mean, we sometimes look at smaller starting points. For us, it's important that there is a clear growth path and that you can fill a facility, I would say, in anywhere 12 to 24 months. So I think sweet spot for conversations is usually just below 100 million, and then increase or larger facilities can be several hundred million before we would need to syndicate. And in terms of clients, we do some, I would say, plain vanilla senior financings, but then also look at younger clients or platforms, challenger banks, sometimes also coming with capital solution for regulated entities, and so it can be a pretty wide spectrum.
Okay, then Sebastian, Walf. I'm running Citi's asset-backed securitization business in EMEA. And what we do is we finance granular asset portfolios, mainly consumer loans, SMEs, credit cards, really whatever is granular. We focus on 3 areas. The major part is senior financing, directly to platforms like in Germany, for example, Aux Money, Auto1, NPAL, Iwoca, so really across the board. The biggest country for us is UK, but we finance platforms across EMEA. So that's senior financing. We also have a business which we call full financing, where we fund 100% of a portfolio. So that's not just the senior part. We would say if you have 100 of consumer loans, Citi would actually fund 100 of that. A recent deal we have done is United Credit in Italy, where we funded these loans on our balance sheet, and then we just securitized them last week in the market. And then the third space where we are in, we invest in platforms directly. So in the operating equity of the platform. So we have done, normally it's a minority interest, so we wouldn't take a majority share because then we need to consolidate it and get in all the banking regulation which you want to avoid. But we take a minority interest in platforms. For example, again, a platform which is active in Germany is Anyfin, where we hold a small equity share as well. So I think that's a quick introduction, and very happy to give more details later on.
Hi, so I'm Michael Stott, and I work at Waterfall Asset Management in London. Mandate's very similar to Daniel. But just a bit about Waterfall in case you don't know. So we're an investment manager headquartered in New York and offices in London and Dublin. Around $13 billion of AUM across 3 strategies: high yield ABS, loan portfolios, principally non-performing loan portfolios, purchasing them, and then principal finance or specialty finance, where we're looking to work and partner with specialty finance companies, finance receivables they've originated, across consumer, SME, more esoteric space, appetite for stretch senior MES, forward flow, and then also if the platform has a receivable that works in the capital markets and they get to scale and Sebastian or René arrange the trade, then we can also take down their MES and equity tranches through the high yield ABS strategy as well. So we aim to kind of really partner with the company throughout the whole life cycle as they grow and develop.
So from the introductory round, you've already taken that. We will also be talking a lot about lending. But when we talk about lending, it's not the business model per se, but it's the refinancing of the business models that we are talking about today. And I mean, in current times, we all know that equity is not as easy to come by as it was in previous times. And we probably also all know that unsecured lending is not an option for every platform, and it's not necessarily, let's say, the most commercial option at all. So asset-based lending is gaining more momentum, or all sorts of asset-based financings, meaning that the platform uses the assets they generate as security to obtain funding on more attractive terms. And Conor, you already mentioned the term warehousing. So maybe starting off to give an overview of the different structures that we see in the market and financing instruments. Can you elaborate a bit more on what we actually are talking about when we say warehousing?
Sure. Well, I'll certainly try my best. So when we're talking about warehousing, we are talking about providing a senior secured loan into a SPV that houses, for us, what are, and it sounds like for most of the panel, predominantly credit income generating assets. There are various different shapes and guises, and I'm sure some of the panel members are better placed to talk about things like forward flow. It's probably worth just mentioning there are kind of variations on the theme. So what we can do, certainly at HSBC Innovation Banking, are providing leverage to forward flow providers, so also known as back leverage. I think what you'll find is in the world of fixed income, there's 10 different ways of describing exactly the same thing. We can also provide seasoning lines to loan originators. So this is sometimes where a loan originator has some form of institutional takeout in the form of a warehouse or a securitization vehicle or a forward flow. But we can provide provide financing against the assets at the operating company before that sell down. That's kind of like the variations of the theme. There's also risk retention financing as well, which is kind of like an interesting play. Whereas, if there is a large public deal, there are lenders in the market that will also provide credit against the 5% risk retention piece that is held by the originator.
Yeah. So on the warehousing side, Citi is also very active in that space, Sebastian. So what is a typical, let's say, the minimum ticket size that you see for those structures? It sounds quite complex, so you need a special purpose vehicle, an SPV, as we've heard. Is that something for everyone, or what is it that you see as an entry level?
I mean, I think it depends on the financing provider. So typically, to get a larger bank involved, it's around 100 million euro as a starting point. And even if you don't have it on day one, you should at least get there within a reasonable amount of time. So maybe within a year. And I think the reason for that is to set up a fully bankruptcy remote structure. I mean, there are legal fees involved. There's structuring involved, time involved. And to make it efficient, typically is 100 million. But of course, you can work with other counterparties like Waterfall or Fortress and look at smaller warehousing lines and then grow them over time until you get to a size where it's getting more interesting for a bank like Deutsche Bank or Citi to come in and finance these assets.
Yeah. So Michael, on that scale, so we've heard Sebastian talk about senior investments, mezzanine investments. You also mentioned that before. So what is Waterfall's risk appetite? So what's really your sweet spot?
It can be challenging sometimes. There's a number of different boxes you'd like to tick, and you're never going to tick them all with a trade. Certainly, a vanilla self-liquidating financial asset like consumer loan is very easy for us to finance. It's easy for us to get leverage on, back leverage. Whatever it may be, then I think actually one thing we're kind of quite interested in doing now is actually intermediating that gap between a company that's relatively new, has funded itself with equity or VC money, and then it can't go to Seb or René and get that kind of much cheaper cost of funds because it's just not at scale yet. So what we can do is come in and intermediate that and grow the portfolio from, say, like a 10, 15, 20 million through to 100 million. And obviously there's a slightly higher cost of funds in that sort of initial growth stage, but then you've got that certainty that once you hit 100, Sebastian, etc., will come in, you get a much cheaper cost of funds, and what was a unitranche then drops down into a mezz ticket. And we've got the sort of same kind of asset there, but a kind of different risk profile, different return. But that's quite interesting for us, and I think it's bridging that gap, especially given sort of availability of equity. VC money at the moment is sort of quite dry, and so we can help a business scale by providing that intermediation trade.
And Daniel, I assume that's quite similar for Fortress?
Yeah, exactly right. And Michael mentioned sort of 10, 15 million. We have actually done a couple of instances of trades where we've started even lower than that in terms of the outstanding portfolio size, just because we've seen sort of the right sort of management strategy, the right sort of origination channels, and really believing in that portfolio growth with prudent underwriting and prudent servicing. But yeah, definitely there is a gap in that sort of, I would say, 5 to 20, 25 million range. So yeah, we try to fill that gap as well, same as Michael, and then grow the portfolio until it becomes interesting for the banks, and then stay in as well in a mezz position, and then ultimately when the portfolio grows to sort of 200 to 150 million, that can also be securitized in the public capital markets as well. But yeah, definitely. Earlier stage platforms we've seen in the last sort of 12 to 18 months are really struggling to get financing because they sometimes lack the track record, lack the performance data. So if we're thinking about, let's say, our advance rate and how much we can lend against each 100 euros of balance, we wouldn't go as high as we would if we had that track record and that sort of statistical inference that we can draw from past performance, which means in turn that the platform will require more capital, but that equity capital is more and more scarce. In the last 12 to 18 months, VCs are retracting. So it's a bit of a perfect storm for some of these guys to struggle on multiple fronts, and that's why we either come up with a smarter structure, or we just have to be more careful in terms of how we underwrite, how we structure our deals.
And maybe moving a bit away from private or public securitization structures, which are quite complex and take a lot of time to set up. And when I say a lot of time, I mean a couple of months, so not years, but maybe months. René, there are probably also less complex structures in the market. I heard the buzzword forward flow. Can you explain a bit further on that?
Sure. I mean, coming from securitization, right, I think you have a similar setup whereby you define certain eligibility criteria and concentration limits for the portfolio that you are looking to build and acquire over time should look like. And then your platform or originator would, on an ongoing basis, every month sell new originated loans into still an SPV usually. Sometimes it can also be via AIF structures or so, which are quite popular for this. And then originators sell eligible loans on an ongoing basis, and you build a portfolio over time, which at the end, then us as a bank maybe take to capital markets and do a securitization, but then it's on the purchaser of the forward flow to arrange that rather than on the originator.
So if we look at those forward flow transactions, which actually at the end of the day do not sound very different than warehouses, so what is decisive for the decision to go either route? So either go for the forward flow or for the warehousing?
I mean, obviously, it starts with economics, right, where it makes sense. When we offer a forward flow, I think it's usually more established platforms that have already a track record, potentially even done their own securitization, where the platform is looking to diversify their funding lines, right, from a typical warehouse that we already discussed to also a forward flow arrangement. Important for us, as I said, is the track record, is the funding situation of the platform, the run rate that they have. We mentioned already the equity markets are a bit different than they were 2-3 years ago, and so we kind of adapt and want to see a bit more substance when we consider the forward flow. Also very important is the arrangement with respect to servicing and backup servicing, right, where the platform is usually the servicer, but for us it's also important to have a backup in place when we start the forward flow.
Maybe just to add, so René's mentioned the diversification point. I think certain themes that we're observing at the moment would be a lot of originators opting for forward flow solutions on the basis that it is balance sheet light. So you are selling 100% of the asset. It's going to generate less cash burn. So when we talk about cash burn, there's obviously operational cash burn of the company, but the financing cash burn also falls away because there's no longer that requirement to fund the 5% or the 10%, that first loss equity piece. And then the other theme we're seeing at the moment would be some of the more mature platforms who are maybe less concerned around liquidity and cash burn, but more focused on valuation. And let's call it late stage VC, early stage PE investors are really encouraging them to become a lot more balance sheet light than they are today, so that they can attain a technology like valuation.
Sebastian, did you also want to add to that?
I think that's exactly the point. From the platform point of view, it's basically replacement of operating equity with asset equity, and I think at the moment that might be beneficial from a pricing point of view to do it that way. And that's why what we see over the last 18 months, that companies who have funded their assets differently, either through equity or through warehousing lines, move on to forward flows. And we have done transactions, I mean, hundreds of millions, even billions of assets which were not used in that way going in the past, but now it's cheaper to do a forward flow than to raise additional equity on the platform level. So I think that's the main driver at the moment, and that's why what we see is actually these forward flows or portfolio sales taking off in the market, and as I said, even companies who have never done it in the past and have aggregated large portfolios of assets actually saying, I need to use these assets, that's the most efficient way for me to get equity, and basically replacing operating equity with asset equity.
And when we look at platforms that have, let's say, more or less recently entered the market, so qualify still as startup companies, What we see a lot of times is when we look at their first financing, so they onboard the first institutional investor, they get a debt investment, but at the same point in time, the investor also wants to see some equity, usually in the form of warrants or something comparable. So what is the motivation actually to take on board those investments as well, or to combine those two worlds? Michael, do you want to comment on that?
Yeah, I mean, I think we typically say that where we're coming in at a very early point in the company's sort of life cycle, we're providing a credit solution, but we're actually providing genuine value to the business, like equity value, so that alongside the kind of credit, the normal kind of interest rate return, there should also be some equity-like return to reflect the fact that when we come in, it will come in at a certain valuation point, and then when we bring in a senior funder or there's a refinancing, the valuation will be increased exponentially. So to kind of provide a kicker alongside the kind of credit product, we typically, not always, it depends on the company and it also depends on kind of the shareholder base and so on and their attitude to the request, would ask for some warrant incentive. But I think historically that used to be a kind of like so-called penny warrants. I think nowadays the kind of custom in the market is that actually your return is the kind of the conversion price for the warrants will be at a discount to the next raise. So you're getting, there is some kind of upside there, but it's not, you're not striking it like penny warrants or anything like that. So there is, when we actually exercise the warrants, we're also putting equity capital into the business, albeit at a slight discount to the raise that the company is raising out.
Yeah, and just to add to that, I mean, there's always alignment of interest in these kind of scenarios, right? Because if the platform doesn't do well, then these equity warrants are worthless at the end of the day, or close to worthless. So there is definite alignment there, and some founders, especially in early stage businesses, are sometimes reluctant to give up these warrants, but someone like ourselves or like Waterfall coming in early and providing that debt capital, really believing in that value proposition and that business model, this actually build up enterprise value in the business, and also it does attract equity investors at the end of the day. And we've seen that in multiple situations in the past, where just us providing a term sheet gets some venture capital firms or some angel investors comfortable to then invest equity in. It's usually a chicken and egg with debt and equity providers in a business, right? The equity guys want to see a debt term sheet, and the debt guys want to see an equity term sheet. So the resolution to that is, not always straightforward. But yeah, we also tend to ask for these equity warrants, and it's especially for someone that's bringing in institutional capital for the first time. It's not always an easy conversation, just because they've built their platform up from scratch to here, and they don't want to give up that, especially if they're paying X for the debt, but it's usually a conversation of alignment and a conversation of building up their credibility as someone that can attract institutional capital, and really building up that enterprise value in the business.
Sebastian, looking at the current challenges that we see, let's say, in the world, not only the world of finance, but more generally the world, would you say that the focus of investors has shifted in the latest months or in the last year?
I mean, the platforms we look at, as we said, are larger platforms, so typically 100 million plus, so they are well established. But I think one of the challenge we have seen is with higher interest rates, in general, more uncertainty in the market. A lot of originators have kind of cut back in what they underwrite and what they originate. So I think the biggest challenge we have seen is that origination volumes have come down, and of course that makes it then often difficult to finance. So fast, if I think back over the last 18 months, I don't think there was a single platform where we had real credit issues. But there were some platforms which were not particularly big to start with, and then they cut back on what they underwrite, and so the portfolios have gone sideways or even reduced a little bit. I think from a credit point of view, that has made a lot of sense for the platform, but it makes it then more difficult for a large bank to fund. So I think that's one challenge. The other challenge is platform liquidity overall. Whereas I think 2-3 years ago, we knew it's quite easy to get follow-on funding on the operating level. I think that's now much more challenging. And so even for asset-based financing, we look in much more detail at the business plan, how the business plan is financed. We still lend to companies which are cash flow negative, but we want to see that there's sufficient equity, that there's backing from strong shareholders. And I think that focus has changed over the last 12 months.
Conor, is that the same that you also see? So any particular questions that your committees may have raised or additional requirements?
Yeah, lots of requirements. I think it's a similar theme actually, just on the company liquidity. So in our business, certainly we only work with and support institutionally funded platforms. So they must have raised at least a VC or a PE round. So that limits our opportunity set quite significantly. But I think there is increased scrutiny in terms of the minimum runway that a company has at the point of engagement, whereas I think before it was probably, if they've got somewhere between 8-12 months left of cash burn, that's probably fine to start a conversation and put something in place, whereas now it's probably closer to 18 months. I think that's one thing. And then the second thing related is where the capital is coming from. So is it an investor that we have an institutional relationship of working with, although they're not contractually obligated to follow on? Do we have a historical relationship of working well together is probably a key aspect of the underwriting.
So René, you mentioned servicing earlier. So given that the return pretty much depends on how well the assets are managed, so how do you get control over that, and do you want control over that? So how important are servicing standards from your perspective?
I would say they're quite important what we look at. We often also see quite a difference to from a really early stage startup, as you mentioned, and platforms that have been around for a while. When it comes exactly to discussing underwriting guidelines, servicing collection policies, there's often a huge difference as how the platforms think about that, how they've defined it, how they've documented it, compared to a much earlier stage company. And so I think with everything that's going on the equity funding side, what we already touched base on, more focus for us is really on, do they know what they do, and an easy way to document and, verify that is, constantly applied to the portfolio. I guess just one more thing to add, what we also have seen is, with limited equity, a lot of platforms wanted to grow very fast in multiple jurisdictions, and we certainly see that slowing down or platforms exiting markets, which I must say per se is not a negative thing for us. So if you then come back, you focus on your core market or home market, I think that's a positive thing for us. So that's not necessarily negative, but on the contrary, when we see someone, wants to grow in 10 jurisdictions overnight, it's a bit more careful these days.
And maybe a quality point as well as regards to portfolio. So, Michael, when you come in as a mezzanine investor, servicing is probably also a big topic for you, given that any losses will hit you first before they hit the senior. So how do you look at backup servicing? Is that something you want to see from day one? Is it something that you would accept to see only at a later stage? So what are your views on that?
Yeah, no, I mean, we would always insist on a backup servicer, and obviously the status of the backup servicer will be kind of hot if it's a new company, and then obviously as the company becomes more mature, you can have longer time periods to elevation. But I think what we're really kind of focusing on now, and it's a common theme I think here as well, is the covenant of the corporate. Like, is it profitable? Does it have cash in its balance sheet? And that also, and then we look at that in a kind of stress scenario. Because actually, I think the reality is a lot of the backup services have a lot of mandates, and if they are actually elevated, they may be on 30 days, but it isn't actually 30 days. It can take a lot longer than that to bring in a backup servicer, especially in a kind of consumer product, and can be quite difficult for them to kind of plug into the systems and collect out. So usually the best outcome is if you can keep the corporate alive to actually run off the portfolio, to kind of retain key members of staff, to incentivize them to kind of collect out. You also don't have to worry about things like IP and licenses and things like that, because an actual stepping into the shoes of a servicer is very complex, particularly in a kind of consumer environment. So we really focused on that. And one thing that we would actually typically now expect in a transaction is that there's some cash reserved on the balance sheet to fund a run-off scenario. It's not going to be a huge pot of cash necessarily, but we look at how long it takes for the book to collect out and reserve that cash. So really keeping the corporate going, and even potentially actually funding OPEX if it makes sense to recover on the investment could also be something we think about in a stress scenario.
Super. Maybe to be very useful to our audience, let's turn towards the gold plating standard for originators and give our audience some tips and hints of what you might be looking at and what may be useful to think about before actually onboarding the first institutional investor. So looking in a first step at the business model and the origination as such. So, Daniel, what do you think is kind of the gold plating standard for originators when you look at the business models?
Look, it will depend on a number of factors, right? What kind of underlying assets they're originating and what jurisdiction and how many jurisdictions. But for us, it boils down to a few factors, all of which I think, bar one, have been mentioned already. One is management. Just management with some experience, with a clear strategy, with a clear, proposition of what they want to do, what kind of, borrowers they want to target, management with knowledge about finance, about regulation, about their own product, about the market as a whole. I would add then origination channels. These are really important, both in terms of volume of assets that the platform can originate and also the quality of these assets. Then with all the leads that come in, how do you underwrite? How do you pick the assets that you actually want to originate? What does that funnel look like? And then once you have originated a financial receivable, how do you onboard it? How do you service it? If something happens, how do you collect on that receivable? Then, we spoke about capitalization already, and we spoke about liquidity as well. These are super important things as well. And even if this is something that's not in place, we would want to see at least a strategy of how that would materialize in practice. And as Michael alluded to earlier, at the end of the day, we're talking about an originator here, but that originator will very likely also be the servicer of these assets, and there isn't a better placed entity than the originator to service the assets. We will have a backup servicer in every deal, but we do want the servicer to be around. And then the one thing that hasn't been mentioned already that we really look for is someone that can be a good partner. And that can mean a lot of things, but it's someone that can ultimately, be a good borrower to us, and contractually we will be the lender and they will be the borrower. But we see this as a partnership, and I mentioned earlier, right, in terms of equity warrants, we take these and we think about alignment. But the whole structure at the end of the day is very much aligned in our view. And if the platform is doing well, we are doing well. We're continuing to provide capital. The portfolio grows. The performance is good. So someone that can act as a good partner, pick up the phone and tell us, okay, we are about to face some issues here. Or, for example, we are seeing performance deterioration in the underlying assets. Or, for example, a key person is about to leave and move to new pastures. We don't want to find that out at a later stage. We do want to have that ongoing conversation with our platforms. And that's what we also do from a lender side as well, right? If the platform wants to move to a new jurisdiction or change their strategy or move to a different part of the credit spectrum, we are super open to listening to that. and helping them grow, because ultimately we do look for a good partner when we do these kind of deals.
So I hope everyone's taking notes on all of this. René, I saw you nodding to a couple of those points. So you agree with what Daniel said?
Yeah, pretty much. I think one thing we'll look out for is more, we see business plans all the time from platforms which almost look like the typical hockey stick forecast, especially 5 years into the future. I think our focus is much more on the next 24 months and having really realistic assumptions, sometimes even challenging them and have them run, like a down scenario or a slightly worse scenario than the original forecast. To see, again, with what we discussed earlier, how the platform is doing, what would the impact be on the platform from a funding and run rate perspective.
So turning towards the onboarding of the investor and then actually running the deal after signing. Sebastian, any tips from your side from the first introductions to signing the deal? Anything that has impressed you that you've seen on platforms where you thought, yeah, everyone should do it that way?
I mean, I think in general, dealing with younger platforms, what we see is the data quality is often much better than what we see from more established banks. And when you ask for performance history or you ask for reporting, in general, that's something which is easier for a newly established platform with only one IT system, no legacy issues. So I think in general, we are quite happy there. So I think in general, like you mentioned, to close a deal takes a couple of months, and I think there's no way around it in a structured finance transactions. But as long as you are happy to invest in time, the time in general, it goes quite smooth, I have to say.
So Conor, some would say that the actual work only starts once the deal has been signed. So any top tips for actually managing the deal after signing and closing?
Top tips. I think when we think of these, we think of the car crash scenarios rather than the gold-plated ones. But I think it's just all about being a lot of the hard work will have been done during the execution stage. So in parallel, the expectation would be that we work with the originator to really put some structure and detail around the level of reporting and the frequency of the reporting and what that looks like. Actually, like road testing that a couple of times during the pre-execution phase can be quite helpful. It just tends to be really about high levels of engagement, I think, being very proactive. I think someone else mentioned, maybe it was Daniel, in terms of, when things are going wrong, it's not waiting until the end of the month when the servicer report is due to actually articulate what is happening or what has gone sideways at a company level is really there. But other than that, it's kind of just proving out, I think, the original investment hypotheses. So, hopefully it's a platform that has, sophisticated risk management, so statistical-based underwriting to predict borrower behavior, and then kind of proving out the business case as well. So hopefully it is a business that has something defensible in terms of its product set. It is, potentially using alternative lending data to enable its underwriting. I'd say they'd be the key things, but mainly just being very engaged and proactive with communication are probably the two aspects I'd focus on.
Perfect. Then to round off our panel, can we get 2 to 3 sentences from each of you on what you currently see in terms of asset classes, tapping a bit on your market insights, and maybe also what your expectations are for Q3 and Q4 to come? Maybe starting with you, Michael.
Yes, in terms of asset classes, we're still very active. We're seeing a lot of opportunities in what we'd call our kind of core classes, whether that's unsecured consumer lending through to SME lending. There's a renewed interest in kind of so-called esoteric assets, whether that's solar, I'm sure Seb can talk about that, through to heat pumps, data centers, looking for kind of non-correlated returns to the kind of core consumer SME book. So I think, and I'll touch on it in my next point, we're kind of confident about deployment for the rest of this year across the UK and Europe, which are core jurisdictions. I think in terms of I think everyone says this, kind of cautiously optimistic. Right now there's some very strong tailwinds. Capital markets are open, have been open for some time. That's a very good, good place for our market, because not always the case. There's a lot of capital available, kind of certainly in the credit side of things, not perhaps so much on the equity side of things. Consumer has remained resilient, notwithstanding some quite significant headwinds. There's been no unemployment shock yet, which would be kind of critical for any kind of consumer lender. Looks certainly in the UK and also in the euro area, looks like those economies are emerging from recession. There's been some very strong prints recently. Germany PMIs. Etc. So kind of looking confident there. I think perhaps one headwind actually is the USA. What's going to happen there? If there's a recession in the USA, as a kind of classic trope, usually impacts the rest of the world. Inflation's kind of coming back there as well. So I think we're kind of watching, and also we're seeing early signs of the kind of delinquencies and credit cards into that in the USA. So and obviously we are based in the US as well, so that's the one thing we're kind of watching. And then just to kind of round off here, again, the kind of inflation looks like it's subsiding. Kind of cuts could come in June, which should be kind of positive. But again, there are still some uncertainty around that. So there's the kind of cautious optimism, I think, is the theme from our side.
Sebastian, what's your view?
Yeah, so in terms of asset classes, one big asset class we see is buy now, pay later. That was an asset class which in the past hasn't necessarily be securitized, but for example, last year there was a big deal from PayPal where they securitized a couple of billion, and there are other portfolios, large portfolios, which haven't been securitized. So I think that's one trend which we see. And these are portfolios which have been funded mainly with equity in the past, and we really see this coming now into the structured finance market. And then the other asset class, like Michael is saying, is like heat pumps, solar panels. We have done this deal for Enpal a couple of months ago. So this was the first large deal in the residential solar space. We hope that asset class will move into the public market in Europe as well. I mean, it's a big asset class in the US, but we haven't seen anything in Europe so far. And also on the SME side, we see more and more securitizations, and we expect that we see more public issuance on the SME side as well. And then I think a general trend on public securitizations is that we will see more platforms from continental Europe. Because to do a private deal, as we said, with a bank is 100 million, but to do a public deal, to make it worthwhile, to pay the rating agencies, to get all of that done, is really more 250 to 300 million euro. And platforms are now getting large enough to actually make that worthwhile. And so we are working at the moment on 3 or 4 transactions with new originators, which haven't done public deals before, and we expect to see that probably over the next 12 months, as long as the markets stay the way they are at the moment. So I think that's key predictions.
Yeah, echo most of that. Maybe just to add, buy now, pay later is indeed, I think, a big topic, also becoming more prominent for B2B buy now, pay later. We also see quite a few on the consumer side, quite a few credit cards or payment cards. There's also a lot of platforms out there, again, in the B2B space. So we see some opportunities there. Overall, I think cautious optimism is probably the right tag for the outlook. I think, looking at our pipeline, it looks fairly busy and healthy. Bit cautious of, we have big elections coming up in the US, which often, might not have an immediate impact on our markets, but sometimes delays certain decisions, be it from equity sponsors to platforms. So that's a little bit on the cautious side.
So I echo all that. I think from our perspective, we continue to have a focus on smaller ticket, short-dated assets, just because we're not looking necessarily to take that longer tail risk. So obviously you can mitigate idiosyncratic risk with a granular portfolio, and macroeconomic risk correlation is a lot lower with short-dated assets. So I think that's where we'll continue to focus. In terms of asset class, I think a lot of them have been mentioned. The B2B, buy now, pay later, is definitely interesting. I think there's been maybe 5 or 6 platforms across Europe that have been heavily funded with equity and are now kind of looking to scale. So the product itself is really just trade credit, but I guess originated in a novel way. So it'll be interesting to see if some of those platforms can scale. And then I think in terms of predictions, maybe a bit of a contrarian view, but we're kind of starting to see the equity markets open up quite a lot for earlier and later stage companies where they were looking to raise and have conversations last year, and no one was even really picking up the phone. Whereas now we're seeing a lot more traction, and expect to see more rounds being closed later on this year.
Daniel, famous last words from your side.
My co-panelists have been pretty exhaustive, so I'm going to keep it short. But in terms of asset classes, B2B BNPL, revenue-based lending, another SME sub-asset class that we're seeing more and more of, and I would say bridge and debt lending as well are probably the asset classes of the moment that we've seen mostly since the start of the year. And then in terms of trends and expectations, I think most of sort of the big risk factors are more or less under control at the moment. So I would echo the cautious optimism, but we will continue to underwrite prudently and be prepared for anything, which wearing the hat of a credit investor you always have to do. And then I would say probably more forward flow transactions than in the past 1 or 2 years will continue to be the trend. I think let's finish on a cautiously optimistic note.
Sounds good. Thanks very much. Do we have any questions or comments from the audience?
Thank you. I've got 2 questions to the panel. First of all, we noticed that new platforms that come to the market are being offered warehouse funding terms that are pretty strict on day one. Let's say, for example, eligibility criteria and concentration limits sometimes would go as far as the alphabet got letters. Obviously, that leads to challenges both in terms of their origination, but also risk reporting. So how do you make sure you don't lose out on business, but at the same time protect your principal? And the other question, as you get to know your platform, your client, their portfolio, the performance, how would you change your risk mechanisms and performance triggers over time to allow the portfolio to breathe, to ramp up, to have some seasoning and all that?
I'm happy to take that, at least a first cut at that. So in terms of your first question, eligibility criteria and concentration limits, I think eligibility criteria, we're trying to follow the originator's own sort of credit and underwriting policy as much as possible. And then sort of if we have or if we want to control what the perimeter of assets looks like, we do it through concentration limits. But especially if we're talking about an early stage platform, I think while we are getting some more performance data and some more track record, I think it is important to have at least some control until we see what in practice potentially could be more or less risky. But coming back to my comments earlier about being a good partner, we try to be a good partner as well. And sort of we are happy, and we do that on pretty much all of our existing deals, to have an ongoing conversation about relaxing and changing these triggers as the platform evolves, as the underwriting of the platform evolves, as we get more and more track record of the underlying assets. So we are not restrictive for the sake of being restrictive, and we are not told, for example, by our investment committee or by any sort of guidelines that we have internally to be restrictive. All we're trying to do is make sure we are not overly exposed to something that we don't know that whether it will perform one way or another. But as the track record builds, we are obviously happy to relax that and evolve together with the platform. And then in terms of your second question, and I think that's pretty much correlated to what I said earlier, we manage performance triggers for early stage platforms, again, by relaxing them as more and more track record builds, and we get more comfort around the performance of the assets, and we get more statistical inference. And what we sometimes do with early stage platforms is, for example, we will start with an advance rate of X, but then subject to some origination volume or materiality triggers and subject to performance staying within certain parameters that are pre-agreed, we are happy to then increase that advance rate automatically if these triggers are met. So that's one way we give credit to track record, and then obviously we are also happy to relax performance triggers as well on the same basis.
I think we had another question in the back, so we have time for... I can see we have two. So let's start on the right-hand side and then move over there before we move to the next panel.
Thank you. So from learning about your securitization mechanisms, I see many similarities with platform regulation, for example, with ECSP, where bankruptcy remote is already present when there is off-balance portfolio. So my question as a platform, do you see a possibility to working through the existing structure of the platform, maybe with smaller checks, and not going directly to securitization, which could, help smaller platforms to develop, and then to move with bigger checks to securitization, which you're used to.
Yeah. I think, again, there's the theory and there's the reality, right? So the theory is, I think we're all structured credit investors, so we're funding assets, not corporates. We shouldn't be taking insolvency risk. Then the reality is we find that often with new stage, there's some contamination. A classic contamination is actually the servicer. Like if the servicer goes insolvent, you're going to get dilutions to 100%. You have to be prepared for that. You have to model for that. What sometimes we've looked at doing actually is a hybrid, is providing like a small working capital line alongside. So maybe the asset needs to be, I think Conor said, the asset needs to be seasoned on balance sheet before it can be sold. So there's some kind of flexibility there. I think doing like a direct corporate loan without receivables that are not truly ring-fenced is a struggle, but there's lots of different ways of structuring things. Like with an invoice structure, you can just buy the invoices directly, and then you've got insolvency remote structure. So I think it's just really more about creativity of structuring. But we're not a direct lending fund. We don't do corporate lending. But at the same time, I think we appreciate there's a cost to things. So for example, we have our own structures, and our preference is always, can we just plug in your receivable to our structure, our fund structure, our SPV structure? So then we're doing all the admin, that's all in place, there's no incremental cost for you. And then as you grow and you scale, then perhaps you set up your own SPV structure. So there's a number of ways of doing it.
And then we had a final question on the left-hand side.
Thank you. Thank you, Jördis, and thank you very much to the panel. For context, I do securitization at Santander, so all this was music to my ears. Something I'd like to come back on is so we discussed the wrestling match between having the debt TS and equity TS, and then we discussed some platforms not meeting their growth plan and maybe focusing back to the core market. How do you guys let's say manage the commitment tenor, and when you reach to the end of such, how do you manage extension, or maybe have you stopped some facilities? Thank you.
Yeah, I can answer that in terms of how we do it. So in terms of the debt term sheet and equity term sheet sort of chicken and egg situation, what we usually see is that if we provide sort of a credit approved term sheet which says we are going to go exclusive and we are going to do our due diligence and we're going to execute this transaction in, let's say, 2 months' time, then that gives most equity providers enough comfort to then continue with their process, but we have our ultimate execution of the transaction and any sort of funding as a condition. We have this equity investment as a condition precedent to that. So unless the equity has closed and has funded and the cash is in the bank, we wouldn't close our facility. So that's how we resolve that chicken and egg. It's sort of a zigzag process, but it tends to work for everyone in most situations that I've personally seen. And then in terms of extensions, we do have that ongoing conversation with all of our existing borrowers. And it's something that we try to discuss as early as possible. Most of our facilities are structured with some sort of exclusivity for us to increase our commitment at pre-agreed terms, which I think is actually something which is super positive for the originator themselves, because they can come to us and they kind of know there's certainty of funding there. But we don't always exercise on that exclusivity, maybe because they've over-delivered, maybe because they've under-delivered. Both of these things have happened in practice. If they're over-delivered and we've kind of locked in terms that are very much off-market, but they could get bank funding at much cheaper rate, then we would just drop down to a mess position, right? But if they've under-delivered, we just reserve the right to either be refinanced or just run off the portfolio. But for all intents and purposes, we try to have these kind of conversations as early as possible, because it's important for us, obviously, to manage our own sort of internal funding and operations, but also for the platform to make sure that they have security of funding and they know what the terms will be of that funding.
So with that, thank you very much to our panelists. Most of you have had some trouble, so we are really glad and do much appreciate that you can be here with us today. Hopefully you will be staying for another couple of hours and maybe can answer some further questions during our lunch break. Thank you very much, and I think that deserves a round of applause.
Thank you everyone for listening. Please find the link to the conference in the show notes and make sure you subscribe to our podcast and follow us on LinkedIn so that you will never miss our podcast. Stay safe and sound and see you soon.